Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. The last half an hour of this painful Friday, 1,000 points down on the Sensex right now at 66,560. The Nifty also seen dragging by 270 odd points lower and nearing the 19,700 mark as well. Let's look at the broader markets and see if the pain has escalated there too. 1.5% down for the Sensex right now. So that's the kind of pain point you're looking after 6 days of consecutive winning streak and the record highs. Small caps holding their ground, thankfully about 0.6% of gains coming in. So some green on the screen, for sure welcome. Looking at the mid cap, that's under pressure. 0.5% declines. Very choppy session so far for the mid cap 100 index. Among the other sectors, slightest of the green you're looking at when it comes to PSU banks today, and perhaps flattish to positive bias on the auto space. Rest of the sectors are all down and out. The IT sector down 4.4%, the biggest culprit in today's trading session. Nifty Bank down 0.5%, financials dragging 0.4% as well, metals down by 0.6%, consumer durables down by 1.4% odd. 0.25% declines on the realty healthcare pack as well. Pharma pack also 0.2% lower in trade, 1.2% down for the FMCG pack as well. So that's the kind of move that you're seeing on the major indices. As far as the top losers are concerned, Infosys still topping the charts on the losers chart, up 8.6% down in trade. HCL Tech follows, Wipro follows, 3.5 to 4% down in trade. Reliance Industries down 3.5% ahead of earnings, and HUL down by almost 4% post the earnings as well. Let's welcome our guest on the show. Mr. Vineet Bulinshkar joins in, Director Research at Ventura Securities. Welcome, sir, and thank you so much for taking the time out for this discussion. Your thoughts, first of all, on the markets, the kind of reaction we have seen. Would you blame Infosys entirely for this fall?
I think there have been a lot of talk of the markets being extended by a number of market participants, and I think just short of the 20,000 mark, Nifty did take start seeing some profit booking, and Infi has actually led the way to that happen. But it is my firm belief that this market will bottom out sooner than later, and from there on we should see some very healthy gains come in. Number of stocks from the PSU banks have started moving up, so they should come and support the market. In line with Nifty, the other IT stocks have also fallen off, and that is primarily the IT is responsible for the whack that the indices have taken.
But Infosys earnings, definitely there was a bouncer and one did not really expect this kind of a move coming in on Infosys. How did you read the fine print of the earnings? And after this, now that the bad news is out and we have seen an initial reaction of 10 odd percent intraday fall, is it the time to buy the bad news at all?
Couple of things that, their guidance range was 4 to 7%. And now they have raised they have revised the guidance to 1 to 3%. So they are guiding revised lower than the lower end of their earlier forecast.
Yeah.
Okay. So that is significant. BFSI is a very large space and they've talked of discretionary spend softness and, ramp up of, pending orders not happening. So that is an area of concern. And if you go to see in the US markets, if the interest rates were to rise even further from here, what we will see is more bank uh, uh, bankruptcies and further tightening of the BFS market, which is very crucial to the India IT outsourcing story. Retail is not in great shape. We all know that, right? In the US. So I think the IT sector spells slight worries. And barring for the fact that the other companies have done well, but particularly pertaining to Infosys, I think the same trend is going to play out in the rest of the pack as we go through the quarters ahead. And hence, we continue to remain cautiously pessimistic. We are not. We have always advocated on your various shows that IT is a sector to avoid pair holdings. and I see this trend only accelerating going ahead. One
Hmm.
more thing about Infosys is that we've seen the margins also come sharply lower.
Yeah.
So all these things are creating a kind of a negative deleveraged, and if anyone is offering 21 times forward forecast and targeting, I think they're going to be in for a rude surprise as we go down 3 to 4 quarters.
Hmm. But does it also mean pain for the entire sector going forward as well? And of the big four IT firms that have reported their earnings, any brighter spots from the worst pack?
So I think TCS is the one that stands out, right? But as a sector, we believe that especially the artificial intelligence that it is taking up, the outsourcing manpower story is not going to last long. It's going to come under a lot of pressure, and artificial intelligence is itself going to lead to a lot of redundancies in a number of requirements.
Hmm.
So we will see some uh, pain for the outsourcing stocks unless they significantly alter their business model. That is a challenge, and it takes a while to happen. It could take upwards of 2 years for them to sustain revenue growth as well as change the mix. So I believe that you know outsourcing stories or consultancy firms are going to be in for bad times as we go ahead, and Infi is the first one of the loggerheads.
Okay. What does it mean for the mid-cap IT space stocks? I mean, if the larger of the pack, Infosys is guiding lower revenue growth for FY24, just 3 months into the year, what does it really mean for the smaller companies and the mid-cap companies? Are they going to face even a bigger brunt?
So, we need to see the results and then take a decision on that. But, I will be very happy to have good results this quarter, because what's happening with Reliance will be the same fate of the rest of the sector. Product companies will be spared. So, if you want to be long IT, you should be long product companies, SaaS models, and highly specialized business processes. Else, you're
Hmm.
going to have a bad time if you're into generic business.
Okay. When do you think things start to look up for the sector? If right now the worst is not yet done and dusted, which we can see from the kind of results that have come in from Infosys, we were earlier looking at maybe the worst is priced in. Some of the stocks had started to move also. But looks
Right.
like there is more pain to stay. But then when do things start to improve and on what factors?
See, we've seen a secular bull market in IT stocks since the early 90s. And we are into
Yeah.
we are well past 2020. So we've seen a run of almost 25 years. And, I don't want to sound like a doomsday forecaster, but, we have to understand that the birth of the IT sector took place in the aftermath of the fiat currency taking shape. You know, and once we move to a peg currency system, which the world is advocating, we are going to see the liberty of printing and the is going to kind of be sharply squeezed. Once that happens, the dollar demise will start taking place. And these are all ominous signs. The government of the United States has also guided to the fact that they favor a digital currency. So, the
Hmm.
printing will always be an issue. Second is obviously the interest spends have crossed certain levels which are not good for a healthy economy. And if
Hmm.
bulk of your business is going to come from two large continents, that is Europe and the United States,
Yeah.
which are facing headwinds in terms of their currencies, interest rates, and macro factors, I think the pace of acceleration in artificial intelligence is actually not very well documented. It's going to be change at an exponential pace, and
Yeah.
traditional business models are not going to survive. So unless you are not a leader in the pack, you are going to have a one hell of a time. And I think that the IT sector will face challenging times going into 25, 26.
Okay. So, if not the IT sector, is the heavyweight lifting going to come onto the banking space now? Is that a space one should watch out for?
Absolutely, in a growing economy and where the infrastructure spend is climbing so rapidly, we are seeing the spend not happening on bare necessities. So, just take for example railway expenditure. Railway expenditure is going to modernizing of railway stations, for example. So, we are moving up the value chain from necessity to,
Sure. All right, we'll try to reconnect with Vineet, but just like how he was mentioning about that, the onus will perhaps be now on the banking space to manage to provide some support to the markets because the IT pack may be in for some kind of a pain point going forward from here, challenging times ahead. So they're not out of the woods yet. And as is clear in the guidance that has been given by the IT space, looks like the sector is in for some more pain to come. But right now the market's still down, 1.12% down for the Nifty, 19,753, 225 points down there. The Sensex down by 855 points right there at 66,719 as well. We'll keep an eye out on how the markets are looking like over the next 10 minutes or so, but looks like we are headed for a snapping of the 6-day winning streak. But things as they will unfold over the weekend as well. We have big earnings coming about. That may be important to watch out for in the next week as well. So we'll continue to watch out for all the triggers and all the news points that will impact the markets and your investments. Do stay tuned with us onto Business Today TV to catch all these updates, and also continue to engage with us on our other social media platforms as well. Until then, thanks for tuning in.
Infosys completes the results season for big tech in India, a season which has been rather underwhelming. My colleague Sakshi Batra joins me to break down some of the key concerns the IT sector is facing. Sakshi?
Largest IT company Infosys has now declared its Q1 FY24 earnings, where the profits have dipped by 3% sequentially. But the bigger disappointment has actually come in the form of its revenue growth guidance. The company has sharply revised its growth guidance downwards